Welcome to The Explainer. Today, we're doing something really exciting. We're decoding the varied strategies of the world's absolute most legendary investors, all to help you build your ultimate financial toolkit. Think about it. The financial markets are incredibly complex, right? Yet certain individuals consistently manage to rise to the top, generating literally billions of dollars in returns. And the crazy part? They don't all use the same playbook. In fact, their approaches often completely contradict one another. But what they do share is a disciplined framework. So today, we're going to extract the core wisdom from these financial titans.
Here's our playbook for today. We'll be covering the value foundation, the indexing revolution, invest in what you know, activism and reflexivity, and finally, building a mental lattice work. Let's just dive right in.
Part 1. The Value Foundation, pioneered by Benjamin Graham and Warren Buffett. This right here is the absolute bedrock of modern investing.
To understand this, you have to look at Benjamin Graham, the father of value investing. Graham lived through the Great Depression. He literally saw fortunes wiped out overnight, and that profoundly shaped his entire philosophy. As this quote hits on, he taught that thorough security analysis is what protects your principal. You don't just blindly throw money at the wall hoping it sticks. You carefully calculate a company's intrinsic value, buy the stock when it's deeply undervalued, and then you just wait. You wait for the market to wake up and reflect its true worth. To Graham, if an asset doesn't protect your principal and give you an adequate return, it's not even an investment. It's just speculation.
And then you have Graham's most famous student, Warren Buffett. He took this exact framework of emotional discipline and used it to build Berkshire Hathaway into an absolute juggernaut. Buffett adopted this model of extreme patience. Instead of getting caught up in the frenetic, day-to-day intricacies of market supply and demand, or, staring at a ticker tape all day, he looks at companies as entire business entities. He's asking, does this company have solid performance? Is its debt manageable? Are the profit margins actually strong? You bring the emotional discipline, and the value framework does the heavy lifting for you.
Moving on to Part 2, the indexing revolution, led by John Bogle and Vanguard. So, what if, instead of trying to find the needle in the haystack, you just bought the whole haystack?
Well, John Bogle looked at the data and concluded something that absolutely enraged Wall Street at the time. Average investors find it practically impossible to beat the market over a long period. So, his brilliantly simple solution? Passive index investing. Instead of paying these exorbitant fees to active managers who try to pick winning stocks, you just track the broader market at a super low cost. This was a direct, unapologetic attack on the active stock-picking culture of his peers.
And looking at this timeline, you can see how Bogle's unorthodox experiment steadily democratized investing. When he launched the first index investment trust in 1976, industry insiders literally ridiculed it. They called it un-American and a sure path to mediocrity. No way, right? But the math was undeniable. By relentlessly driving down fees across the entire industry, a phenomenon we now call the Vanguard effect, Bogle proved that lowering your costs is hands down one of the most reliable ways to increase your returns.
All right, Part 3, Invest in What You Know, championed by Peter Lynch. As we're going to see, everyday observations can actually be your greatest advantage.
Just look at these numbers. Lynch achieved a staggering 29.2% annual average return over a 13-year period at Fidelity's Magellan Fund. He did this by picking overlooked stocks, easily outperforming other incredible contrarians like John Neff and going toe-to-toe with hyper-aggressive macro funds. Lynch basically proved that a retail investor is often way more capable of spotting trends than some Wall Street fund manager who never leaves their office. Your eyes, your ears, your common sense, those are incredibly powerful research tools.
Actually, Lynch coined the term Tenbagger. It's a baseball reference for a stock that grows to 10 times its original purchase price. And he found these explosive stocks using his simple philosophy of investing in what you know. My favorite example? He bought Dunkin' Donut stock, not because he read some complicated Wall Street Journal analysis, but simply because he loved their coffee as a customer, and he noticed their Boston locations were always packed. He took that initial real-world observation, dug into the financials, and boom, it became one of his best-performing stocks.
He also popularized a really powerful hybrid strategy known as GARP, or Growth at a Reasonable Price. This tool perfectly balances the massive potential of growth investing with the strict discipline of value investing we talked about earlier. Basically, you want the share price to increase rapidly, but you never want to overpay for the initial stock. It's all about finding that sweet spot where a company is growing fast, but the rest of the market just hasn't fully priced in that growth yet.
Part 4. Activism and Reflexivity with Icahn and George Soros. What happens when you don't just pick stocks based on reality, but actively try to force the market's hand?
Enter Carl Icahn. He mastered the art of aggressive activism and a pretty controversial tactic known as greenmail. Icahn's strategy is wild. He finds companies that are fundamentally undervalued, usually because of bad management. He buys up a massive chunk of their stock and then relentlessly forces corporate changes. He pushes for board shakeups, asset sell-offs, whatever it takes to unlock shareholder value. Honestly, just the rumor that Icahn is looking at a company often causes its stock to spike. It's literally known on Wall Street as the Icahn lift.
Now, on a massive global macro scale, George Soros utilized a distinctly different approach. Traditional models assume markets always tend toward equilibrium and that participants have perfect knowledge. Soros called this the cognitive function, just trying to understand reality. But he argued, wait, there's also a participating function, where our very actions actually alter the reality we're observing.
And that brings us to his famous theory of reflexivity. Financial markets don't just passively reflect fundamentals. Soros argued that a participant's bias can literally change the underlying economics, creating a two-way feedback loop. When investors believe a boom is happening, their massive influx of capital can actually cause the economic boom to manifest, creating these dynamic boom-bust cycles. Soros exploited these exact cycles with highly leveraged, deeply instinctual bets, generating average returns of over 30% a year for decades.
Finally, Part 5. Building a Mental Lattice Work, guided by Charlie Munger and Ray Dalio. So, we've covered a lot of contrasting tools today. How do we organize them in our own minds?
The late, great Charlie Munger, Warren Buffett's brilliant partner, fiercely warned against single-hammer thinking. I mean, if you only know how to value a stock based on a simple P/E ratio, you're going to apply that formula to every single situation, even when it makes zero sense. Munger argued that a true investor absolutely must build a multidisciplinary latticework of mental models drawn from psychology, economics, biology, physics, you name it. If you look at a problem through multiple lenses, you eliminate your blind spots. Munger actually relied on a strict checklist of these mental models to deeply assess a business's true character. Take conversion, for example. Instead of asking, how can I make a ton of money on this, Munger would invert the problem. He'd ask, what could cause this investment to completely fail? Or take the Lollapalooza effect. What happens when multiple psychological biases all push an investor in the exact same direction at once? By running his decisions through this checklist, he dramatically reduced his errors of judgment. Ray Dalio did something very similar when he built Bridgewater Associates from a two-bedroom apartment into an absolute institutional powerhouse. He didn't use a single stock-picking trick. Instead, he established rigid, transparent principles. He created an idea meritocracy, where successful navigation of reality and relentless risk management totally trumped ego. Whether you're using Munger's mental models or Dalio's principles, the takeaway is the same. Long-term success requires a formalized, structured way to process the chaos of reality.
So from the ultra-passive, low-cost simplicity of Vanguard's index funds to the hyper-aggressive philosophy of George Soros' reflexivity, we've seen today that there is no single right way to beat the market. The best investors in history didn't just guess. They deeply understood their chosen framework and executed it with ruthless discipline. So take a look at your own portfolio. Are you relying on a single hammer, or are you building a complete lattice work? Which tool will you reach for next? Keep building that toolkit, stay curious, and I'll catch you in the next explainer.